with Keller Williams. So I was going to do just a quick little update about what's going on in the market. But before I do, so this is an update regarding insurance and what it means for loans and buying houses. So you know that after the fires, a lot of changes happen with insurance, and there's a lot of information that buyers should know when going into the buying process, especially when they actually get their offer accepted and start, the process in escrow. Sort of what tricks and tips, we would tell you so that you can have a better experience, so that you're kind of ready to go in guns blazing, and have the best option. I have a successful escrow, because getting an offer accepted is one thing, and having escrow closed is completely another thing. So I wanted to introduce Toros to Gian. I told you about him. He's with House America. He has over 20 years of experience in the mortgage industry. He could tell you a little more about himself when he talks. And Rose Seropian, who is with Opus Insurance. She handles all kinds of insurance, right? You do health, you do house, you do car, all of the above. And so she can update you on what products are available. And, if one thing is not an option, what's another option? If that's not an option, what's another option? So the great thing about having like small little team like this is that we kind of confer with each other, talk to each other, come up with strategies, and make sure that, we don't get stuck halfway in escrow.
Rose, you want to go ahead?
Kind of like what you guys have seen recently with this whole fire situation.
Well, starting from I would say a year ago or 2 years ago, things got harder in the insurance market. There's been a lot of non-renewals. Some companies stopped writing, but we are still in the market. We have Farmers, and if Farmers doesn't work, we have other options where there's always an option for insurance, basically. So the next option would be California Fair Plan, and we can do a companion. So, I know it holds up escrows and new purchases, but there's always options. So, there's been rate increases. Yes, that's because of inflation, labor costs, materials go up, and then some companies, they stop writing. So that's another factor. The ones that are still writing, they're going to raise their rates because, the demand goes up for it. So people need to understand, why there are rate increases. It's also because of claims happening in areas. A lot of claims activity has gone up this past 2-3 years. So that's another factor. Other than that, these fires happening, it might have an impact, but we don't really know what's going to happen. Nobody knows. For the next year, we're hoping that they don't leave people, up in there without insurance. A new laws, the commissioner's enforcing a new law not to non-renew these people that were affected by the fires. So we're hoping that can help out a little bit and give people a break. But again, nobody really knows what's going to happen. We're all, in the same situation up in the air. We're all thinking, what's the next, it's just, what else do I say?
I have a question, Rose.
Sure.
So like on the insurance industry, I've been kind of researching, trying to figure out, do insurance companies have internal departments where they assess risk? For example, they have like internal teams who would like gather data about certain areas, geographic areas of, let's say the Palisades. They look year over year, it's dry, there's they haven't cleared brush, they haven't done this. So are they doing this internally themselves, or they're buying this information from like third party and then like kind of analyzing to see where's the risk and then to pull out of that entire area?
That's a good question. That's why they are looking at certain areas, and they know there's it's a high risk area. There's good question. Yeah, I mean they do have inspectors, third party. They do go out and they inspect the area and they make sure that um they have been what is it called? I mean when they do the clearing, the brush, they clean up the brush. I don't remember what it was called right now on the top of my head.
Yeah, like like brush clearance.
Brush
Yeah,
clearance.
Yeah, they do the brush clearance, and if it's not done, um, then they non-renew you. But they are trying to avoid risks. So another one would be like installing a water leak detector device. That's a new one. This past year, farmers has been making exceptions, giving insurance. You would have to install that device in order to get insurance, and if you don't do it, they're not going to renew you. So they are trying to they're coming up with new things trying to avoid these claims from happening
yeah,
because
yeah. Like if somebody were to put like a those sprinkler set up on the roof, and clear brush, are they going to be basically in better shape as far as keeping their insurance?
yeah, we've been getting a lot of notices like that lately from all especially Safeco. They've been sending letters and they've been doing aerial view photos with the satellite. I don't know how it's a new thing, but they basically take a picture of your roof from up on from satellite, and they send you an inspection report saying, here we see your roof has issues. You need to either get this done. You have tree branches touching your roof. You need to trim those down. They're trying to make people do their part so then they could try to avoid as many, they could avoid claims. But I mean, people are not happy with that. But I mean, they got to understand that insurance companies are losing a lot of money too when these things happen. So they're trying to, change some stuff around to prevent all these claims happening. Because they are losing money, and people need to understand why these rate increases are happening. But I mean, some insurance companies are willing to work with clients so they can keep their home insurance. And if the customer doesn't comply, then you gotta go somewhere else.
So Rose, that's for current homeowners. What about new home buyers, like whoever's like in the market? And maybe Toros, you can chime in. Is this something then in a negotiation a buyer can ask credits for, so that they can ask for brush to be cleared or anything like maintenance related to give them a better rate for the insurance? Can they ask credits for that? Is there anything like that?
The only thing I've seen is if they're part of a wildfire mitigation. I've seen that credit. Yeah, if they do clear up their brush. Other than that, it's more like what the zip code. They look at the zip codes. But if you are in a high brush area, I mean, they don't give any other exceptions. They're either going to take you or not take you. And then when that happens, I mean, we always have other options. But as far as like credit, I mean, it would be just alarms if you have alarm. Other than that, yeah, it's either they take you or they don't, basically.
So there's nothing a buyer really can do to get a better. It's just the location is going to be pretty much what determines it.
You're in that zip code where they're not accepting it. Yeah, there's no other choice.
So what would your advice be for someone who puts an offer in and they get their offer accepted? Like, how soon should they think about talking to someone about the insurance? When should they get into that process?
Well, the sooner the better, because I mean, there's some companies, they will give you a policy, but I think there's a waiting period. Some ask for like inspection reports, so you have to do a self-inspection with your phone, show them around the house. I think AAA is doing that. It does take some time until they get approved, so the sooner the better. They gotta jump on it, or else it's hard finding insurance now. It's not like before. So
can you explain?
And I've been seeing the contingencies for insurances be more prominent lately. We never used to see insurance contingencies. Now it's part of the contract. And I have seen that agents and buyers are even asking me, or they're shopping around as they're putting in an offer to get quotes. So that is very recommended, because it could be very expensive depending on where you are. Like Rose said, like if you're in a high brush area, it's going to be pricey. So the sooner you guys find out, the better it is for the lender, because that premium is going to affect your debt to income ratio, which means it could affect your qualification. So we do our job in trying to estimate, but we don't know where you guys are looking all the time, right? Granada Hills, Glendale, Tahunga, etc. So it's always good to do it even at the submission of the pre-approval or the offer part.
Okay, so even as they're putting the offer in, before they even have it accepted, it would still be a good idea to call up the agent
Just to get an
for the
idea,
insurance
at
and get an
least.
estimate
Yeah.
and see whether or not,
Yeah,
okay.
because there's some properties that have claims on there, right, Rose? I mean,
Yeah.
we've had this happen quite a bit because, you know, I send a lot of clients to Rose, and
Yeah.
sometimes there's been water damage or whatever the case is. So just that alone either disqualifies them or increases their payment substantially. So yeah,
So
that's why it's good.
again dependent on the property itself or the person who has the claim. So for
Both.
example, if the
Now they're
seller,
actually looking at the property
So
itself.
both.
Where it was,
Okay.
if you were not the person at the time that owned the house, they would let it slide. But now they're looking at the house itself and saying, "Oh, this location already had a pre-existing water damage, so most likely it couldn't happen again." So
so
they need,
even that affects the
yeah. So they want
insurance.
they ask for a lot of stuff. They ask for proof of remediation, receipts, pictures. It could be stuff that, you know, the new buyer doesn't have or can't present because it happened with the previous homeowner. I mean, it could, yeah. There's a lot of factors.
Right. So starting early basically is sort of the overarching kind of recommendation.
Yes.
Start early, so if there are any issues, problems, they could come up as soon as possible and could be addressed, whether it's to cancel the contract or whether it's to just go ahead and get the insurance that is available. Can you talk a little bit more about the different types of insurance? Because we've been hearing a lot about the California Fair Plan, but I feel like from my conversations, I've heard people not realizing that the California Fair Plan needs to have supplementary insurance. Can you explain that a little bit more? And then what is that, like a last resort, and what are the options before?
Yes, it's called difference in condition. So, and these companies won't give that policy to you unless you have a California Fair Plan. So they're gonna ask for that proof also. So you do have to have California Fair Plan. But I think the most important right now is, I mean, Taurus, would they let you purchase just California Fair Plan, or do you have to have a companion? That part, because I think some stuff have changed.
Yeah.
If I'm okay with just fire.
Yeah, because the California Fair Plan pretty much covers everything except for water and liability, I think, right?
Yeah.
So before it was much easier. Us and other lenders that we use, investors, were allowing it, just the Fair Plan by itself. But especially now, everybody that I've been come across over the last few weeks is also asking for the DIC policy as well, because they just want to make sure that everything is covered, not just the fire, the vandalism, the wind, the hail, the ash. They want to make sure the liability and water is also covered.
Oh, we could do just liability and fire. Would that be okay? I mean, as long as if they have
No, they want water too.
water damage.
Because if there's a water damage, remember, it's all about the collateral, right? As a lender, we're insuring the collateral, not just the land, the house itself. So if there's some kind of water leak or water damage and it's not covered, that puts the lender at risk, because you won't have enough money to potentially fix it. So now you're going to lose your house, not make your mortgage payments, etc. So that's why lenders are becoming more cognizant of this. And the water is the key. Liability, it's important because Fannie Mae and Freddie Mac require a complete coverage. But now, especially after the fires, it's more aware of what's involved and what's not. So we're seeing more and more people, even on the non-QM sector, asking for the DIC policy now.
So let me ask Rose a question about what it actually costs. So I know that depending on if it's admitted, non-admitted, and then the California Fair Plan. There's obviously differences in those. But if you were to go with the best and the most, coverage, all the bells and whistles, and if you were to look at maybe a fire area, so let's say Tujunga is mostly inside of the fire areas. There are some parts towards Sunland, I guess, that were not included in the moratorium, for example. But and then the hillsides of Glendale are all part of that. What are homes in those areas like costing people?
Looking around, Toros, we've seen what, 6,000-7,000.
Yeah, we're seeing some pricey ones.
We've seen pricey ones, and if that's too pricey, I mean, we've been able to do like a companion supplemental difference in condition policy with California Fair Plan, which been more cost effective. So it's I mean, it all depends on the client too, if they're looking for quality versus how much they pay for the insurance. We've had people say, you know what, I'd rather go with Farmers because I'm more comfortable, it's a better company. But then there's the people where they have a budget, and if we do it that way with 2 policies, it could be cheaper.
So what does that low end look like?
3,000, I would say, right, Toros?
Yeah,
We're
give or take.
a lot together.
Yeah, a lot.
So between 3,000 to 6,000 is sort of the range that it's costing now for insurance.
It used to be around like 1,000 to 2,000. It was average, but now it's like triple, I would say. Yeah.
And from what I'm seeing in the market trends, it's showing that even house prices are not going down. Year over year, I mean, Tujunga had 12% increase from last year. And that was just in a normal market when we were still low on inventory, but with even more houses now gone from a near area, in Altadena, 5,000 plus homes. So now there's going to be even bigger demand with still the same inventory. So the trend is showing that prices are not going down on that. So are there any loan products, Toros, that you guys have, or down payment assistance, any way to kind of balance out these high prices and high, cost of insurance, to help people still be able to get into their, to homes? Is there any down payment assistance programs, anything that you can suggest?
Yeah, there's definitely a lot of programs that we have. We pretty much here at House America, we cover every kind of program you could think of, from down payment assistance to full document to limited document to no document programs, from ITIN borrowers to citizens and everything in between. So the problem is with higher insurances and higher prices becomes higher debt to income ratios, which is a huge factor in qualification. So that's where the problem lies. Getting somebody into a program, that's kind of the easy part now. It's making sure that they qualify for that program. That's where the problem is because first-time homebuyer programs usually have income limitations, debt to income limitations, credit limitations, and things like that. Just like pretty much every program, but usually a little bit more restrictive. There are FHA options that we have, which kind of give us a little bit more of a looseness in the ratio requirements in some aspects, lower rates, things like that. But there's other requirements for that as well. So everything comes good with the bad, and the pros and the cons, I should say. So there are the programs that are available. It's just we have to make sure that they qualify. And if they don't, we structure it to where we're prepared in the coming months to where we qualify.
So that's another thing. So I'm meeting with a lot of first-time home buyers who are going from renting, to buying, or that they're trying to perhaps set that property to rental property and then buy a new property for themselves. They're trying to upgrade, upsize. So for people like that who are planning on making this kind of a move, how can we help them plan out so that whatever they can control and have control over, that they can work on, so that their debt to income ratio falls in the range where they're able to do it, because they can't control insurance, they can't control the rates, but what can they control, and how can we help them plan this out so that they can do it?
The control is the personal debt that they have, right? Like the purchases of the auto loans or leases, credit cards, co-signing for somebody, things like that. You don't want to do any of it, right? Minimize it and speak to your lender as soon as possible, right? So they could evaluate the situation for each person and see where they're at. We've talked to a lot of people, me and you, Armin, for some of your clients where they thought they were ready, but they weren't. And then the other people that thought they weren't ready, they were more than qualified. So everybody's situation is different. Our guidelines are different. And the best thing to do is talk to the lender to see where you are. We don't have to do a hard inquiry. We could do a soft inquiry, so it doesn't really affect the credit at all, and get a really good idea of where things are. And if it's ready, then it's ready. If it's not, at least we could come up with a game plan over the next 1, 3, 4 months, whatever it may be, to become ready. So, and of course, no credit inquiries, no debts is the best way to do it.
Right. From what I'm seeing as well from a lot of the home buyers in the market today, they are not prepared. So for step one, I always suggest talking with a lender. That is my first suggestion, to get the pre-approval, to get the plan in place, and so that they are, they're not faced with a surprise. For example, the price of the insurance, or for example, the debt to income ratio being so high that their rate is not what they expected. But on that note, can you also do us a little bit of a review on where we stand with rates? I know that it hasn't really moved much in any direction, but where do we stand now?
So yeah, let me pull it up here real quick. So rates have gone up over the last few weeks, months, but over the last few days they've been coming down, right? And currently with Trump being in the office, the speculations is maybe more rate cuts will happen, lower rates will happen. That's what the overall census is. But rates as a low balance, if you're a first-time home buyer, you're looking at somewhere in the mid to high sixes, depending on if you want to pay a point or not. And that's if you have certain income limits or not. And then if you're in the high balance range, you're looking at somewhere in the low to mid sevens, probably in that range somewhere. So rates are higher than they were back during COVID. Rates are lower than they were last year. So, we're not saying eights. At some point we were saying eights for full doc loans, but we're not anymore. So that's good news. But we're expecting rates to come down a little bit more.
I did want to share, I do have a graphic sort of showing the rates, and I'd like to share with everyone the median prices that we have now in some of the areas.
Can I ask a question about rate real quick to Todos?
Right.
Is it possible to lock it, right? First, and then how long does that last usually?
The only way to lock in a rate is when you have an accepted offer, because a rate lock is associated with a property, not just with the person, right? It's for the person, but it's also with the property. So let's say, for example, you get into escrow today on 123 Main Street, rate is 5%, whatever. But you cancel escrow because of inspections or whatever the case may be. And next week you get into escrow for 5, 6, 7, 8 Main Street, right? Rate is 6%. You go with that rate. The rate goes with the property.
Okay.
Yeah.
Thank you.
And actually, Rose, as well, I would like to ask if they can lock in their insurance rate, because from what I also was reading and understanding is that once they are able to pay for and lock in their rate, even if they are not finished with as soon as they start escrow, even if it hasn't finished, escrow hasn't closed yet, they're able to lock in that rate no matter what happens afterwards. Is that the case?
When it's in quote status, or when
the quote is, when the quote, and then once they pay. So
I mean, rates can change month to month basis, but once you issue the policy, you're locked in for a full year. But yeah, quote, if you do ahead of time, it could change. I mean, the first of the month is always when the rate increase is in effect. So yeah, there's a possibility it could change. That's why it's better to get the quote maybe within the 30 days of issuing the policy to prevent that. But yeah, it could change. So, but once you lock it, once you issue the policy, it's locked in for a year.
And what are you seeing in terms of days from when they inquire and ask for the policy and when it's issued?
You can do 60 days. You can get the quote up to 60. Some companies are different. They'll do within 30 days and some would do in 60. But they can go with the quote date. So if it's
what about when they're putting an offer in
Mhm.
and they need to close? So when will they expect to have the insurance so that they could take out that contingency and be able to, close escrow?
As soon as I get the request, I can issue it. Yeah, as long as they
Okay.
tell me when's the effective date, I can do it in advance and just issue it and have it ready for that closing date. Sometimes
Okay, so it's not taking like long
No.
periods of time.
No. And Bruce knows I'm quick at that stuff,
She's
right?
very good at it. Yeah. So usually I send her something, let's say today, I'll have a quote by either later in the day if it's early enough or the next day.
At
And it's
least
done
by
deal.
the next day, right?
Yeah. Yeah.
Okay,
So
so
that's why I
you don't
love
need to
working.
put like a 30-day contingency, insurance contingency in the offer.
No, I'm seeing just standard, like same dates as the loan contingency. That's what I'm saying, because in case there's problems, it gives us time or gives the agent time to shop around and get the policies and then explain to the borrower, figure out the property, the insurance, and it takes time. So I'm seeing relatively the same time as the loan contingencies.
Okay, that's good to know. I'm going to share just really quickly the information that I have so far, and then we'll open it up to questions. And Audrey-chan, you can ask questions if you have any. So these are the median sold prices by city, and you can see La Crescenta, San Fernando Valley, Burbank, Los Angeles, and Glendale. And this is change year to year. So comparing 2024 December to December 2023, you can see that there is in all cities that there is an increase in the median price. And this is not what is listed, this is what's been sold. And a lot of these properties are being sold either at asking or above asking price. So this is also the landscape to take into consideration when you're putting in an offer. I know that we're kind of in this sort of static stage where we're like, oh, but this is too much for this property. It's just a small building. Why does it cost so much? But we say that every single year, and every single year we do see that the prices go up. So if you are planning on, making a purchase, think about the change over think about change over time. This is another graphic showing the different markets. As you can see, La Crescenta, Tahunga, Burbank, Glendale are all still in a seller's market. And the seller's market just indicates that the inventory available in each given month is below the amount that's in demand. So there's more demand, there are more buyers, and less inventory. So that kind of drives it down to a seller's market. There are certain pockets of each area where we do see a little bit of a shift towards a normal market. But so far, this is where we stand. So, we are not seeing any change in terms of prices going down. If we do see price going down, it just probably means that it was overpriced. The number of homes that were sold during November, December, this is the change month to month. So these are the last months. In La Crescenta, we sold about 30 houses. In Tahunga, 49. In Burbank, 160. And in Glendale, 187. So there's still, people out there still buying, still selling. There is a lot happening, although we are seeing a drop. So this negative 33% here, 7.5% here, 7.5%, and even Glendale, 22% from November to December. That kind of indicates a little bit of people's fears during the elections. So that might not be, what we see going forward. So we'll see what happens in the next few months. This is what I wanted to show because this is a really good graphic showing where we are in terms of rates. So this is showing from 1972 to 2022. And at some point in 1982, we were at 16.63%. So our 7.86% sort of average that we see is a little bit higher than we have seen since the 2007, but it is kind of tracking in terms of like what it's been on an average for the last few years. So there isn't going to be, it's not surprising where we are. And historically, it's really not as bad as we think it is going to be. This is the escrow process. I'm not going to go into this, but I did want to just go over some of the current market updates and let you guys know what's kind of happening in our area here. So do you have any questions, Audric, Biana, Mike?
So hello everyone, can you hear me?
We can hear you.
Okay, so just one question. So does the rate affect the cost of like initiation and the cost of loan? If the rates goes up or down, are they going to be the same?
The cost itself is going to be the same, right? Because the loan costs are the same, the title costs will be the same, irrelevant of where the rates are. The house prices might be impacted, so the higher the rates go up, typically or historically, we see that purchase prices will stabilize, but not since COVID. It has not been the case. But the cost, no. Now there is a thing called rate buy down. That's a different topic. So usually when the rates were in the 8% or higher, we saw a lot of people paying points to buy down the rate, but that's a separate cost aspect of it. But no, cost will be relatively the same.
And one more question. So if you are getting a second mortgage, so is the first mortgage considered as your debt in your debt to income ratio?
Yes. Anything that's reported on your credit is going to be going against your debt to income ratio, including the first mortgage, the property taxes, and the insurance, and any HOA dues that there are on the subject property and any other property you own.
Okay. Thank you.
Of course.
Any other questions?
I have a question, Toros, about that when you said something. So if I have an investment property that I'm leasing, somebody's renting it out for me, and I'm actually making income, does that still count as debt if the it's covering the loan and I'm actually making income? Does that cover?
That's a very good question. It depends on how you file your tax returns, but no. If, let's say, for example, you write off a lot of expenses, let's say repairs or utilities or management companies or things like that, those get deducted from your income. So let's say your mortgage is $2,000 a month, your rental income is, let's say, $2,500 a month, but your utilities, your expenses like repairs and management companies and other non-deductible, expenses are there. And let's say they're about $600. So you're technically only making $1,900 a month. So you're losing $100 only of a liability, not the full $2,000. So whatever you get, we could at least offset it a little bit from your liability.
Okay. Got it.
Any other questions? Biana?
Yeah, I have a question about the debt to income ratio. What's the number one way or the easiest way to improve that number?
More income is, so basically it's all about income and liability. So the most simplest way to improve it is to minimize your debt, right? Because that's controllable. So for example, if you had a car payment, you want to get it out of your name, you want to pay it off, somebody else is making the payments for it for 12 months. There's ways to offset some of that liability. And then of course the income. So if you get a second job, that'll help out. If you get a pay raise, that's going to help out. But there's rules to every one of these things that take place. So that's why it's, each situation is slightly different. But minimizing debt is usually the best way.
How would co-signing help with the income portion? Would that be
It
also a way
definitely
to-
would help as well. Yeah, but most people, just because there's a co-signer doesn't mean you automatically qualify. The co-signer will actually have to contribute and is subject to the same rules as you, right? They still have to have whatever debts they have and whatever income they have. So they would actually have to have a lot more income than debt to actually help you.
Right.
I have a question. This might be a super question, but so the debt to income ratio is a whole family's, right? Like if I'm buying a house and my income isn't that high, so I have debt. So can I transfer some things from my name to my wife's name, and then I apply for the loan myself? My wife's name is not going to be, so that'll help too, right?
Yes, unless you're doing an FHA or a VA loan, then no. But if you're doing a conventional loan, yes, that is one of the ways. Like I was saying, like transferring the debt, that's one of the ways to do it. Exactly. Very good. Yeah, it's a very good question, actually. So definitely not a stupid question.
Are there any special programs for example, county workers, firefighters, or I know that there's like these loans that are specific to certain groups. What are those that you can mention?
So there are some programs with them. They're not always readily available, and they might not always be the best program for them. So it depends, but usually they allow for lower down payments with no MI in most cases. Sometimes the programs are available, sometimes they go away. So it does vary about the program.
Okay. And can you talk a little bit about the 2-1 buy down? I know that that's something also that we're getting to see a little bit more now. That the interests are
Personally
higher.
speaking, I don't really care for the 2-1 buy down myself. I don't think it's that great of a thing, but the seller has to give you a credit for at least the amount of the 2-1 buy down cost. So there's a cost for that. And what I mean by a cost is usually it's about 2.25% of the loan amount. So the seller or the realtor has to usually pay for it. In most cases, it has to be the seller credit to pay for it. And what the cost is per se is the total of the difference in the payment between the actual payment and the buy down payment. So what a 2-1 buy down is, the first year you get 2% less. The second year you get payments based on 1% less. So let's say your payment is $1,000 and then 2% lower, let's say your payment becomes $750. So the first year you'll be paying $750 a month. So the delta of that, which is $250, is times that by 12. That's the first year cost that you need a credit for. The second year, let's say it's 1% less. Let's just say it's $100 less. So that's another $1,200 a month or a year. So you would need to get the $250 plus the 100. So that's $350 times that by 24. That's the amount of credit you need. So you could get that credit and have slightly lower payments. Or, what I recommend is getting that credit and pay for all the closing costs. And that way you get that immediate savings. And then when you refinance, it becomes a little bit easier.
Do you also have refinancing options? For example, I know that I've been hearing some lenders do that. I'm not sure if you guys have that option where you provide free.
Yes. I hear that a lot, but just like with anything in life, I really don't believe that anything is free. The reality of it is when somebody says free refinance, somebody's paying for the cost of that refinance, right? And what lenders don't tell you, and I like to be very transparent, is So everything is like a seesaw, right? The higher the rate, the lower, like the rate goes higher. So let's say there's a par rate. Let's say it's 7% at no points, no credits. If you get a lower rate, you get more of a credit. So let's say you get a 6.5 rate, you have to pay. So points increase while rate decreases. But if you get a higher rate, you get a credit back. So when they say that they are going to do a no-cost refinance, what they're not really telling you is, instead of giving you, let's say, a 6%, they're going to give you 6.1% or 6.2% and say, we're going to credit you the cost of the refinance. But that's not really ethical, in my opinion, because they could say, you know what, you could pay for it, but get 6%. So I think it's more of a gimmick that lenders are doing to try to draw up business, but that's the reality of it. So nothing in life is free. So you're ultimately paying for it by getting a little bit higher rate.
Yeah. Well, thank you for being one of the more transparent and honest lenders that I've actually worked with. So, and I want to say thank you to Rose as well. I know that it is a very difficult, constantly changing atmosphere market that we're in right now. So I really appreciate you guys coming on here and updating us with the information you do have. Hopefully we'll get more information in the next, few weeks and months, and we can have another meeting like this where we can update everyone on what new things are happening, if there's a change, and if there is an improvement, and how we can contribute to helping anyone who is looking to buy or sell even in this market, and help them navigate it so that they are they're not losing money, and they're not getting stuck in escrow, they're not falling out of escrow, and they are being protected, because ultimately I think all of us can agree that we've sort of made a commitment to our clients that we will protect them as best we can, and look out for them, and give them all the best options that we are able to do. So really appreciate you guys. Thank you so much. This will be shared as a recording, so we can spread the word and have everyone be a little bit more empowered. Thank you so much, Audrey, for joining us. Diana, Mike, thank you so much.
Thank you, guys. Very
have
informative.
a good night, everyone. Yes.
Thank you.
Okay, thank you.
Good
Thank you for the information. Have a great day.
Thank
Good night.
Good night, guys.
Bye-bye.
Bye.
Good night.